Hello, chart watchers, and welcome to this Wednesday, June 6th, Market Watchers Live show with your hosts, Tom Bowley and Aaron Swinlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Stock market looking pretty good this morning. The Dow Jones Industrial Average climbing back above 25,000. It is at 25,028, up 228 points today. The S&P 500 up 12 points, easily clearing now the double top established back in May. The NASDAQ continuing to move higher at an all-time high currently at 7660. Russell 2000 also climbing into all-time high record territory, 1668, up another 3 points today. 10-year Treasury yield climbing up over 5 basis points back to 2.97%. With a rising Treasury yield, that means money is rotating out of bonds, and that is moving into stocks. Very bullish action indeed. Volatility index continuing to drop, now down below 12. Down another 3.5% today. Bear markets don't exist with volatility levels at this, or volatility indexes at this level. Financials continuing to perform well here over the past week or so since bottoming near that early May low. Financials have been being accumulated, and we're seeing it again today with that Treasury yield higher, money rotating back into financials. Banks having a very strong day after hitting multi-month lows around that 455 area, holding on to support. We are now moving back toward the highs on the banks back in mid-May. Autos doing extremely well today, making it about 5 or 6 days in a row where we've seen mostly strength. Tesla today, it's been General Motors and recently, but today it's Tesla. Very strong volume today on Tesla as it makes a break above 310. A close above 310 would be very bullish there. Healthcare providers, one of the areas I've talked about recently, I think is acting much better, very bullish. It is up today, trying to make a breakout after holding its 20-day moving average recently. I believe JP Morgan is the best performing stock in the Dow, but the second best is Boeing. I wanted to mention because it looks like Boeing is making a breakout here, trying to climb above that May 21st high. It is up $8 today, 2.3%, up to $368. Okay, well, Aaron, it's Wednesday. Market's doing really well. How are you doing?
I'm doing really well as well.
Well, that's a lot of wells.
Yes. No, it's a great day to watch the market. I love it when we're having a nice rally like this, especially when I see my portfolio going the right direction.
Yes.
Good morning.
Yep, that's always a good thing. And it's always a good morning, too, when we got Charles Kirkpatrick on the show. Welcome back, Charlie.
Oh, hi.
How are you doing today?
Very well, thank you.
Where are you out of, Charlie?
I'm at Kittery, Maine.
Okay, so you're at Maine. So I guess the snow.
You're looking at the ocean.
I guess the snow has ended.
It has. Thank God.
We're into June. We're in meltdown mode now. That's cool. Well, we're going to have you in here in about 10 minutes or so. So please stick around. I know everybody's excited to hear from you today and give them your latest thoughts.
Okay.
So we'll get back to you in about 10 minutes. Okay, Aaron. Well, we got a busy schedule, and I know everybody wants to hear from Charlie. So why don't we get into the weekly announcements and the agenda and get this thing rolling?
Absolutely. So for the upcoming week, of course, we have Charlie Kirkpatrick here today. Bruce Frazier, Mr. Wyckoff will be joining us tomorrow. Everything Stock Charts is Friday with Chip Anderson. And then Tom, in case you forgot, you have a workshop coming up on Tuesday. Yes. Hopefully you're thinking about it anyway.
That was the first time I just thought about it.
All right, we're going to bring Charlie back at 12:15, followed by our 10 and 10. And our first stock is going to be Gap GPS. And then we're going to finish off with drilling down. And I know both Tom and I have some interesting stocks we'd like to share with you and how we find them by drilling down. But let's go ahead and get started with the technical news and headlines. So take it away, Tom.
Okay, sounds good. The 10-year Treasury yield today, as I mentioned earlier, up 5 basis points to 2.97%. This is the highest we've seen it since that big drop toward the end of May when we went from 3.11% all the way down to 2.76. This bounce back is not a surprise, though. We did hold on to the prior support level. We are in this pattern of higher highs, higher lows, and I expect this to continue. I do think that the long-term pattern of lower Treasury yields that we've enjoyed for about the last 4 decades, I believe it's over. I don't think we're going to go screaming higher in interest rates, but I do think that we are now in a period of rising interest rates. And I think that that is going to help fuel a bull market. As long as we've got rates still relatively low on a historical basis, but rising because of strengthening economic conditions, I think that is a great environment for stocks. Money will rotate away from bonds, and where else is it going to go? I think it's going to go into the stock market. With a rising dollar that we've been seeing, I think more than the fair share is going into small caps, and that has been a theme for 2018, especially over the past 2 to 3 months. I think that will continue. If you're interested, I always go over economic reports, and I just wanted to pull up my blog here and make sure you're aware that toward the bottom of the blog, I do every day list the economic reports that come out. Normally, my blog is posted sometime between about 8:45 Eastern and 9. So anything that is released probably 8:30 and earlier. Well, not too much is released earlier than 8:30. I think ADP employment comes out 8:15, but there are a lot of reports that do come out 8:30 Eastern. And as far as checking those out, you can go to the bottom of this blog article every day to find out what's being released. This morning, the only thing out was Q1 productivity. Came out with a rise of 0.4%. The market looking for a rise of 0.7%, so a little bit less than expected, but nonetheless still pretty good action there in terms of economic news. It was at least positive, which is what we want to see. I wanted to go over a couple of things here in the market. First thing, I was on a rant before the show started. I'm going to tone it down quite a bit here. But if you're watching CNBC yesterday, David Stockman came on and was talking about how he thinks the S&P 500 is going to drop back to 1,600 or potentially could drop back to 1,600. Yeah. I'm not saying that it's not possible, but when you get the exact same thing from the same person over and over and over, year after year after year, it really gets old and stale. But CNBC, for whatever reason, still parades these guys back onto their show. Well, I know why. I don't have to ask why. It's because of ratings. Anytime you're going to scare the heck out of people, they're going to tune in to try and find out why they're going to lose all their money. And so I think CNBC has a history of bringing back folks who absolutely never get it right and or rarely get it right. One of these days, maybe we'll have a bear market, and then Mr. Stockman can toot his horn. But he was on yesterday, had nothing good to say about the market, and thinks that things are wildly overpriced. But let me tell you, he said the same thing 1 year ago. He said the same thing back in 2016. And he also talked about the same thing back in 2011, 2012, and 2013. So throughout this entire bull market, he would have, if you were following his sage advice, you'd been in big trouble. And I just point this out because you want to be careful. I really do. I've said this many times before. CNBC is all about ratings. It's very little about knowledge, about worrying about you getting the knowledge you need to manage your money. Just be really careful who you listen to on that station. Okay. And again, I toned it down. Erin, I just toned it down a lot. But anyway.
It was quite the rant this morning when we.
Yeah, I was really upset. I don't mind somebody having a different opinion. I honestly don't. If you think the market should go lower and you're bearish, that's one thing. But at some point, you got to let go. You got to let go of that stance, or you just are not credible. And so that's the part I have a problem with. But anyway, let's keep moving because there's a lot to go over here in the market. And we want to get Charlie in here in about 5 minutes. Taking a look at the market, you can see the Dow Jones up 219 points. We are back up above 25,000. And when you pull up the chart on the Dow, you'll see 25,000 is a pretty big short-term level off of the selling that we saw to put in the double bottom back late March, early April, and then go back and test it again in early May. The reaction high, we had a double top right around 25,000, and now we're challenging that. I think we're going to get through. The reason that the Dow is underperforming, in my opinion, and has been underperforming, is that rising dollar. These last couple of months, yes, we've been going up, but we've been going up much slower than, say, on the Russell 2000. And look at the chart beginning of April on the Russell 2000. Completely different picture from what we see on the Dow Jones. And I know I talk about this a lot, but I really think it's important. When you've got a dollar that's going up the way the dollar is going up right now, the small caps are going to get more than their fair share of the money. Domestic companies here in the U.S. are not subject to the currency translations of doing business overseas. If you're doing business over in Europe or over in Asia and you've got a really strong dollar, those profits earned over there have to be translated back in more expensive dollars, and that cuts into your earnings. That's why, again, you're going to see the Dow Jones Industrial Average really meandering. It's the strength in the economy is there, but on a relative basis, money is rotating into those smaller companies as opposed to these big conglomerates that do business throughout the world. Many of these companies have a large percentage of their business done outside the U.S., and so money is simply rotating. It's not that these companies aren't doing well. It's the impact of the rising dollar. And I personally think the dollar is going to continue to rise. I look for a big move higher in the dollar throughout 2018. I'll talk about that a little bit more in the show. But in the meantime, I think you have to at least be aware of that and possibly considering at least keeping a percentage of your portfolio in those small cap stocks. Let's take a look at the sector summary. I don't go over this a whole lot in the show, but I start off every day. As soon as the market opens and we're in, 10 minutes in, I normally am pulling up the sector summary just to see where the money is rotating. I talked in my blog this morning when I saw the 10-year Treasury yield higher, figured that the financial group was going to do well, and you can see financials easily leading the pack today. And if you click on the financials, it gives you all of the industry groups within this space. This is exactly the leadership you want to see. Banks, investment services, asset managers. These are the more aggressive areas of the financial space and these areas do well when the market is or when the economy is strengthening, especially banks. And the reason being, interest rates go higher. And when rates go higher, the net interest margin on banks expand and their bottom line grows very quickly. So I think the strengthening economy also cuts down on loan loss reserves, which is a big expense area for banks. So you've got really an exacta, if you will, for the banks when the economy is strengthening, because they have fewer loan losses that they have to reserve for, and yet they also have an expanding net interest margin. And so you can see banks leading. This is not shocking. And when we go into the chart for the banks, you can see that the recent lows down around 455 held, and we are making a nice move back to the upside. Think, no, that's not what I'm trying to think. There was an ETF. I can't remember it now off the top of my head. One of the bank ETFs is doing really well. I'll think about it in a bit. But I did want to mention a couple individual stocks. VRA, this is Vera Bradley. They beat bottom line. They raised. The stock continues to move higher. There was some anticipation of a good report. We got that good report, but the volatility today, the stock is traded from 12.68 at the low to 14.93 on the high. Very heavy volume. I love the pattern. I love this fundamental report. Now the question is trying to find a good entry point on the stock. If we were to pull back anywhere close to that 12 level, getting down close to that 20-day moving average, I think that would be an area to keep in mind. Signet Jewelers also came out with a great report. This is a stock, if we go back, that has been downtrending for quite some time. I'm going to go back a couple of years here. But you can see that this downtrend has been for real. The last couple of big earnings reports have been gap downs on heavy volume. We're going the other way today on Signet. So a nice move to the upside. And if I pull up the relative chart on SIG, you will see that it is in the apparel retail space, which has been on fire. This stock has been an awful relative performer. Here's Signet relative to the apparel retailers, which has been just awful. Also versus the S&P 500, it's been awful, but it is a strong group. And now all of a sudden we've got a really nice recovery here on Signet. So I think this could be the start of maybe some outperformance on this stock, which had been underperforming for so long, but now comes out with really good news. They raised their guidance, and they've also got a strong sector and industry group, which is helping to carry it a little bit higher. But that is a relative strength. And I know that, Charlie, you're a big fan of relative strength. I know you're here to talk a little bit about the volatility and all, but I think this is a perfect segue to bring you in because I do know we've had discussions about this, that relative strength is really key in success in the stock market. I think we have Charlie. You there with us? Hey, there you are, Charlie. How are you doing today?
My voice is very soft, so it may not come through very well.
Oh, no, you're fine. But I was just mentioning, relative strength. We were talking about it before the show, and I know you're a big fan of relative strength. I don't know if you had any comments on Signet Jewelers before you get into your presentation, but do you like it when a stock is in a strong group, has been underperforming, and then all of a sudden comes out with some really solid fundamental news and looks maybe to be turning the corner? Does that interest you, or do you need to see a little bit?
Yeah, absolutely. Sure. I run various significant numbers on stocks relative to all other stocks. And this looks particularly good, at least as of today. It didn't yesterday.
No, it did not. But they do have fundamental news that kind of changed the picture. We'll see whether or not the technicals continue to hold up. But I'm going to let you get into it because I know you got a lot, and everybody is really kind of sitting on their hands and trying to wait and get this information that you're ready to share with everybody. So I'm going to let you take it away.
Okay, good. I had asked Tom and Erin what they thought was most interesting or the subject most in demand to cover, and they mentioned volatility and risk. And I suspect that that's because where the market is high as it is and with only some stocks participating, people are interested in how they can protect themselves. Where was I? Oh, okay. Let's look at first at the generality, and that's what do you do when you're investing? And so there's a number of decisions that have to be made, and the first, of course, is that whatever you have to pick an investment, and that's what Tom and Erin are helping out now. The next step is to actually buy it, and that's a separate decision. Not one that one that a lot of people labor over, but it's actually the easiest decision in the whole process of investing. The next problem you have is, what do you sell it? If it goes up, do you sell it right away? Do you let it go with the fear that it may come back and you don't make any money? Or on the other hand, maybe it's at a loss. And how do you know when to sell it when it's declining? That's the element of risk that I want to talk about. And it all boils down to having some kind of risk plan, as to what you're going to do. Because when you get to a loss, of course, you invite all sorts of psychological barriers there about being stupid and why did it go against my best judgment and so forth. So most investors, as this outline says, spend their time picking and buying when really they should be considering what their risk is. And it's very rarely considered. So the next major step is to come up with a risk management strategy. And in fact, you'll find that most professionals don't have a good risk management strategy. If you own a mutual fund, for instance, if you ask the manager, what is the specific criterion you use to sell a stock, you'll often come up with some kind of a generality that's not a plan. It's not a strategy. And this is equally so for most people. But it's a terrible error because the law of percentages is working against you. Now, a lot of people consider risk to be equivalent to volatility. Volatility is a measure of risk in a very specialized sense, but it is not. It's not going to save you. Volatility doesn't tell you anything really, as far as risk is concerned. The two most common measures are the Sharpe ratio and the Black's, I spelled his name wrong, I think, option calculation. And so your question is, or most question is, do you buy low quality, no volatility stocks because you're supposedly risky, or do you buy high volatility stocks because they're going to make you more money? And the use of the standard deviation is a terrible mistake because it doesn't measure risk. It measures volatility, but volatility is not risk. And when we boil it down, Well, let me show the next one. This is a hypothetical situation. The vertical axis in this case would be the standard deviation. A stock that has declined by this amount has the same volatility as a stock that advanced by this amount. So volatility would not help you in this. It has no bearing on whether you make money or not. Whether you make money or not is if you buy volatility, high volatility, but have a risk plan that gets you out of it so that you don't end up being like stock A. And most volatility measures don't consider the upward volatility, which is favorable. Let me switch this, okay? So risk management is really the science, if you will, of preventing you from buying or keeping stocks that are potentially going to decline. That is called the drawdown. Drawdown is really the measure of risk. It's a measure of how much money you're going to lose or what can you lose. And that's your concern when you buy a stock, not whether it's oscillating back and forth. It's whether you are going to lose money on it. Now, you're never going to get it perfectly, of course, but your attention should be focused on what is the likely drawdown. Now, we got two kinds of risk in the marketplace. Actually, these are the most common or largest. You have market risk, which is if the entire market declines. And the problem with that is that almost all stocks go with the market on the downside. So if you're going to be a successful investor, your best bet is to, of course, not participate in the market decline and to save your money for when it bottoms. Now, a lot of people say that's a difficult thing, but it really isn't. There are very simple methods of determining whether the market is headed downward or not. Moving average crossovers are probably the most common, and I use them. Momentum oscillators, yes, but they don't work as well when you're rising. And then you have ancillary information, for instance, interest rates, as Tom's talking about. You have sentiment measures. You have debt measures, consumer confidence, and so on. So when you begin to see all of this stuff falling into place as to when it usually occurs at a market top, then once the market starts to go down, you'll get the confirmation with your moving averages. You have to get out of the market. You cannot ride it downward. Now, ironically, most fund managers are forbidden from selling the market. And this is a decision based on sales of mutual funds, not of management of mutual funds. The sales department is very important in most mutual fund companies, and they don't want you to sell because they can't turn around and sell the fund to somebody if it's only got a large amount of cash. So most fund managers are stuck on that, even if they could time the market. It's also something for you to remember. If you happen to be in mutual funds, they can't go, or in most cases, they cannot go into cash. And that's all called market timing. Now, the other risk you have, of course, is in the individual security that you own. And in order to measure the minimum drawdown, which is your risk, it is your risk. You have to go back and look at the history of the stock. And I'm assuming we're talking about only stocks at this point, but this is equally valid for anything, real estate or, commodities and so forth. Prices are based on their trend and the volatility about that trend. The trend is measured by relative strength. And for this reason, I very strongly advise that you buy stocks based on relative strength. Now, the problem that most people have is that they want bargains and therefore tend to look at stocks that have low relative strength, and they're hoping that it will turn. And some do, some don't. But the problem is you don't want to waste your money in a stock that's not doing it. You want to put your money into something that's very strong. Now, then the question is, how do you know when to sell it? And the most popular amongst the hedge funds is using what's called the ATR. The ATR is average trend range. Now, the trend range for most people is what's the difference between the high and the low during let's say a day. But a fellow named Wells Wilder came up with another way to calculate that using 2 days. And the reason he did that is because if you use just the range between high and low and the stock gaps the next day, it's not, your measurement of the high and low is not telling you what the actual change in the price of the stock is. So he just added the fact that you use the close of the previous day and you measure the high from today versus the close, the low today versus the close, and the actual range, and whichever is the largest, you take it and use in your calculation. Then you average this over a particular period of time, and what you get is the sort of the average oscillation of the stock in dollars for that, for the period that you're watching, but it gives you a rough idea of what the range is that you can expect in the future. Now, if the stock changes direction, it's obviously at some juncture the trend is going to turn. And when the trend turns, the oscillations will become larger on the downside. And at some point, they will, if it's true that the trend has changed, at some point they will break through and behave in a manner that is, well, I guess you'd say wider. And for instance, if the stock is moving upward at a regular pace, when it declines more than what oscillation occurs, what an ATR occurs, you know that something strange is happening. Now, it can do it upward too. It doesn't have to always occur on the downside. But what you do is you create a trailing stop. It's called a chandelier stop, which and it's a trailing stop, and it's based on the high of the stock as you own it, and it's measured by how many ATRs are below and above the stock price at any particular time, so that when and if the stock price declines below that ATR, you know there's a change in trend occurring because that's out of the ordinary, and it's changing downward in that case. So people will use that as a stop, or what they'll do is they'll take maybe 2 times or 3 times the ATR just in case there's random hit. And but if it's down 2 times the ATR or even 3, then you know you got a real problem and you should sell it. It's not something that you should be interested in anymore. Now, I give you how the true range is calculated. As I mentioned, it's all based on either the close of the prior bar or the current bar range, and whichever is larger is the one that's used in the calculation. Here's a picture of the true range versus the standard deviation. Standard deviation is used mostly in option calculations, and it is also used as a means of determining risk. The problem is that standard deviation is based on the closes, and it's based on the percentage change of the closes, and it doesn't include the high and low and the actual range that the stock might travel through during a particular period. So the average true range does do that, and that's why it's used much more amongst the professionals. So if we boil it all down, your object, of course, is to buy a strong, very volatile stock and to reduce the risk of a drawdown. And to do that, you have market timing, which gets you out of the market entirely when the odds are increased that you're going to lose money no matter what you do or how smart you are, because that when the market starts going down, all stocks go down. But however, when the market is advantageous and is rising, as it is today, you use relative strength to select stocks. And I'm talking more about not so much trading, but more as an investment vehicle. You could also use it for trading too, of course. You want to trade the highest strength and the highest volatility stocks. And that's your secondary criterion is you buy the high relative strength stocks, and then you buy those that are in that category that have the highest volatility, because you're going to get the most bang for your dollar. And to prevent a large drawdown, you use a trailing stop, as I mentioned, with the number of ATRs. So it sounds very simple, but and it is very simple actually. But of course, then you get all the psychological problems that occur with investing. Now, I don't know whether you have any questions or not, but I certainly.
What you were just talking about, but when I look at a stock like Apple, here's a company that, when we look at the market cap, it's almost $950 billion, almost $1 trillion company.
Right.
I don't know what you thought about this, but I mean, 10 years ago, I never even dawned on me that we were going to have $1 trillion company, within the next decade. Does it bother you that a company's got that size of a market cap? Is that something that you consider to be risky, or do you just continue to follow the charts?
Yeah, I don't look at market cap except from the standpoint of liquidity. I mean, can you get in and can you get out? Most of my customers are institutions, and they have a restriction on the amount of money that they can throw at a stock, and not affect its price. So Apple, of course, would be a very liquid stock, and therefore would be one to be considered. But if, on the other hand, if it's not very strong, then you don't want it. And whether it's a big company or little company, the odds are going against you if it's not in that high category. So bottom line is, yeah, sure, but it's got to prove itself with strength and volatility.
All right. Do any of these, any of the big companies, the FANG stocks, because, so much money has been pouring into it. You always worry about, the masses because so much money is rolling into certain areas of the market or certain individual stocks. Does it bother you to see Apple and Amazon and Facebook and Google, Netflix, all these companies seemingly going up year after year without a really significant pullback? Does that bother you, or is it similar to Apple in terms of, just being okay with it so long as, charts aren't breaking down?
Yeah, no, that's not a consideration. As you know, I mean, well, and as you pointed out, some stocks will go up for a very long time. But then, yeah, you like digital equipment and some of those others that get crushed in the market declines 10 years ago. Their end will come, but you don't know when it is. And so if it's still in that category, in that very high, strong category, it doesn't make any sense to sell it. And for instance, I was just looking up Apple right here. I got a relative strength of 83. Well, that's pretty damn good. It's not way up there, but for, as you say, a heavily capitalized company, that's pretty good. And as long as it stays there, then you keep it.
I've got one stock, and I'm trying to kind of zero in on how you look at relative strength. So I'm going to pull up a chart of a stock that hasn't really been doing too well in 2018, but has a really nice long-term track record, and that is Monster Beverage, MNST. And I've pulled up on the chart here, 15-year chart of Monster, where it was down, under 10 cents a share 15 years ago. Now it trades at $53, but it is down from, being much higher recently. Let me get a daily chart in here. And if you look at a daily chart, you'll see that Monster over the past 4 months has been declining from $70 down to $53. So when you look at a stock like this for Monster, are you more inclined to follow what's been going on here in the short term with a couple of these gap downs and the trend lower and obviously the poor relative performance over the last few months? Or would you be more inclined maybe to step back and look at that longer term chart where we've seen such great returns on Monster? How do you look at an individual stock like this?
Well, the first thing I do is go and look and see what the relative strength number is.
Okay.
In Monster, it's 6 out of 99.
So you don't like it. I think that's fair to say, right?
Well, yeah. Well, see, I'm playing odds. It's pure odds. I mean, I've back tested all this stuff and run it and walk forward optimizing and all this sort of thing. And well, as it turns out, the way it's calculated is the current price divided by a moving average, and the best moving average is 31 weeks. Well, that's about 3/4 of a year, and so it's a sufficiently long time to work out the sort of minor oscillations. And by using that, and again, testing what happens if you choose a stock with a relative strength of 6, there's no question you can hope that it returns, but the odds are against it. And your odds are much better. It's sort of a buy high and hope it goes higher kind of investment method. But in my mind, and all the tests that I've done, it is the most successful way to do it. Now, if you're going to trade it, that's a whole different question.
Okay. So it really depends on your time frame and your own strategy, obviously.
Yeah, when you see, it depends on when the company may be great. I'm not questioning that. It depends on when you actually get enough buyers to start running the stock. That's, in other words, you can come up with a great story, but you can sit with a great story for a long time and nothing happens. It's only when the stock is bolstered by other buyers that something is happening, and that's when you want to jump in.
One follow-up question. I know Erin's got a couple questions for you from the chat room, but we were just talking about the interest, having having the institutions and so forth interested. When you talk about relative strength, I'm assuming that all you're looking for, when you say that Monster's a 6, that this is based solely on price action. How much of the volume, how much do you pay attention to volume as a stock starts to move higher?
None at all.
Okay, it's strictly based on price.
Pure price. Yeah, that's what you're buying and selling. So, and I don't mean to denigrate volume. I mean, volume is a very important statistic, but in this particular method, it's irrelevant.
Okay, gotcha. Fair enough. Erin, you have some questions?
Yeah, we did have, let's see. You've answered some actually in your questions, Tom. One person was interested in, when do you use stops, Charlie? And if you do you use points or do you use like a percentage or, for your trailing stop, if you were to use points or percentages?
Yeah, some people do that, but the problem with that is that if a stock, its character changes and it becomes more volatile, in other words, it swings in wider swings, you don't want to get caught in a stop with one of those swings, because the swing itself is purely an oscillation. It's not a change in trend. And that's why I much prefer to use the ATR, because that adjusts back and forth as to how the stock is oscillating, whether it's and so in that case, I wouldn't use a percentage change. I would use the ATR. Use like 2 or 3 ATRs as your stop point, your trailing stop point.
Now, I just again, a follow-up here. I pulled up Apple and I put the ATR in here. Is there a certain level for those who are using the indicator at StockCharts? Is there something that would really maybe trigger your concern holding Apple based on the ATR? I mean, is there something you'd be looking for here?
Well, yeah, you've got the ATR itself, but what you want is to make a chart where the ATR is following the stock price itself. You can see that it rises when the stock price rises, and now is declining. Usually that's a sign when that something big is going to happen. As you know, low volatility leads to high volatility, and usually a directional change. So now it doesn't mean you can't foretell whether it's going to be a change upward or downward. But again, what you do is you draw a line that's, let's say we use two ATRs. So the ATR today is, what does that look like? 275, something like that?
277. Yep.
Yeah. Okay. So if we took say a three times the whatever it is, so you get something up around 12 and a half, somewhere between 12 and 15. So you then draw a line that is, or a dot that's 15 points below the close on the chart. And then the next day you do the same, and the next day you do the same. And you'll see that at times it's been up as high as 4.5 points, which again, if you'd used the 3 times, would give you a much higher number for your plot.
Right.
And if it breaks that line, then you know that the stock is doing something not ordinary. It's something different.
Do you ever?
Yeah.
Oh, go ahead.
No, go ahead.
I was just going to say, do you ever use like recent price lows themselves as maybe a confirmation to what you're doing?
Well, yeah, you could. You certainly could have like a breakout from a support or a resistance.
Okay.
But and that's your confirmation. I mean, I'm a great believer in not acting on any one particular indicator, but having another indicator confirm what your first indicator is telling you, and having it come from a different source. In other words, if you're using a stochastic, you don't want to use a RSI as a confirmation, but certainly a breakdown or breakup would be different.
Yeah, I think you raise a really good point there, because we talk about that a lot with technical indicators, that, you know, you can always find one technical indicator if you go back and back test that happens to be working pretty well in history. Right. But then all of a sudden you start putting your money into it, and you're like, why isn't this working anymore? And the problem is you've just got one technical indicator supporting your thesis.
Yeah, exactly.
Yeah, you need more than that. Do you have anything else, Erin?
Yeah, I know you've talked about it as you've gone along, but is there, you talked about, I think Monster having a relative strength ranking of 6.
Right.
What exactly is like your formula? Like, if the thing is, people are asking, how do we scan to, you know, build a scan from it? So, I mean, in particular, you know, what formula do you use to come up with those?
All right. Well, the formula is and this is in my book on investment and trading strategies. The formula is the closing weekly price as a ratio to its 31 week moving average. So you take that ratio for every stock on the exchange. There's, I don't know, 8,000 of them, and you measure. Then you rank them all, and then you divide them into percentiles just for ease, so that you can quickly tell whether one is stronger than the other. And so when you get a ranking of 6, it means that 94% of the stocks on the exchange are doing better.
Mm-hmm.
And then, you know, my tests, of course, have been, okay, let's say I buy it at 6. What happens statistically over a period of time? And you lose is what happens. I mean, in other words, the relative strength ranking tends to stay the same for a substantial period of time, at least 6 months, but not always. And if it starts to change rapidly on you, then you know you got a problem.
And you said that you're taking the price weekly close and dividing it by the average of the last 31 weeks, did you say?
That's correct.
How did you come up with 31?
Purely by experiment.
Okay. So, I mean, it's safe to say, I mean, when you look at a stock like, Monster, again, if we go back on that monthly chart, it's got a great long-term history, but the calculation that you're coming up with is really focusing on the past a little bit more than a half year. Half year would be 20 weeks.
Right, exactly.
So it's really ignoring everything that took place prior. So the one limitation, if there is one, is that it's more of a short-term evaluation of relative strength.
Yeah, you're correct. If I use a longer one, it won't work.
Okay.
I've tested it all the way out to 2 years, and 2 years on that moving average. And when you get out there, you find that the results are random. You don't get any advantage.
Now, when you see a stock like Monster, which has got a relative strength under your calculation of a 6, is there a level that it gets to that begins to get your interest? So let's say we start to see a short-term rally in Monster, and now all of a sudden, the next time you do the calculation, it's at 20, and then the next time is at 30. At what point does it begin to draw your interest in something you might want to take a look at?
When it gets to 97, 98, or 99.
Okay, so it's got a ways to go then.
Yeah.
Okay. Perfect.
Well, I mean, there's a lot of stocks out there, so you're trying to get the best one. And that, to me, is how you do it, Monster, I mean, it'll happen someday. I'm not questioning that. But right now, you want to have the strongest stocks that exist.
I'm just curious now, what's your relative strength ranking on like an Amazon?
Okay, hold on a sec.
I would think it's going to be in the 90s because it is up for 2018. It's got to be doing better than a lot of stocks.
Yeah, it's 92.
92, okay. All right.
So for those of the listening, the StockCharts technical ranking is determined in a different way. So if you go to Chart School and look that up, you can make those comparisons. But at this point, they're two different relative strength ranking systems.
There's a lot of them. I mean, Value Line has one, and I think O'Neill has one. And the problem is that when they're tested, now I'm not saying this about the stock charts because I don't know what the formula is, but when I knew or could find the formula for these various relative strength rankings, I found that you just didn't get anywhere near the performance you do with this. For instance, a lot of them try to combine, short-term relative strength plus intermediate plus long-term, or they use a percent change, for example, between today and, it's a rate of increased business. And those are flawed just logically, but it turns out they don't work. And I don't think that relative strength is the magic thing and that it works all the time. It doesn't. You're playing odds. Let's face it, that's what you're doing when you're investing. You're playing the odds that you get a real good stock that works to your advantage, but it only works during certain periods. It works, for instance, if you shorten the time period that you calculate the relative strength, you actually get a negative correlation. You get where a strong stock is the worst thing that you can buy. Because what you're doing is you're shortening down to its cycle, and it will correct during that cycle. Once it's made a short-term peak, it'll correct down and you lose your money. So the time over which the calculation is done is very important. And as I say, the longer you get out, the less it tells you anything. It's just almost totally random. It's kind of that sweet spot in there.
Yeah, I will say that this has been an awesome visit for sure, because I think two of the things, is we've had a number of guests on here and things that Erin and I talk about, a lot of the questions that come up in the chat room and so forth. A couple of areas that we tend to focus on quite a bit is relative strength and managing risk. And I think you've done a great job actually of taking a look at both of those for us today, and kind of giving everybody an insight into how you manage risk and how you look at relative strength. So we certainly appreciate you coming on and sharing all this with us, Charlie.
Okay, well, I thank you very much for inviting me.
And we're going to have you back. So make sure that you got it marked on your calendar. We're going to get you back. I know everybody would love to hear from you.
Come up with something new.
There we go. Thanks.
You always have something great to say.
Always. Thanks again, Charlie.
Okay, great. Thanks for you guys.
All right.
There he goes. And you can see we've had 182 responses about relative strength in trading and investing decisions. 58% say that it's very important in their trading and investing decisions. 35% say it's important. So that's 80 or 93%, 92, 93% in total view relative strength either as important or very important. And only 8% say it's not important at all. I tend to agree with the majority there. I think it's extremely important.
Yeah, I absolutely agree. That was what I voted.
Yes, I didn't vote, but I'm voting verbally. I'm going to vote very important. So anyway, let's move on to the 10 and 10. I know we got a bunch of stock requests and so forth. And we're going to start off with GPS, correct?
Correct. Let's see. I ended up with 48 symbol requests. Go ahead and like your favorite ones in the chat room, and the most popular will be our second symbol, regardless of when we looked at it last. So go ahead and make those votes. But yes, we have quite a few requests today, so your chances of getting yours picked are pretty slim.
Oh, let's not say it that way. Maybe we'll get it picked. Who knows? We'll look at some good ones though.
Yep. So that's the longer term RRG that we have right now. And look at lots of them in the red for the longer term, which is interesting. Usually we don't get as many requests from the lagging sector. So with that, go ahead and take on GPS, and I'll start putting together the rest of these stocks for you.
All right, sounds good. You know, I should have held Charlie in here for another minute or two because we talked about this one before we went on the air, and GPS had come in as a question, so we featured that as our 10 and 10 lead off today. And I know Charlie's comment was that he had some comment about the relative strength being very weak. So I think he was saying, I hope this isn't one that you like, Tom.
Yeah, exactly. I remember that.
But I think that, you know, he's correct. I mean, we've seen this is a group. These retailers have done extremely well. We're seeing them break out. And when you look at Gap, you know, we're still sitting around the $31 level. Back in January, we had a high at 35 and a half. So, yeah, on a relative basis, this is a stock that's really struggling. So I think that in the short term, it's got a chance maybe to go up and fill this gap from the huge gap down we saw just a couple weeks ago. So maybe 33 is in the cards in the near term. If we can get through that level, things will start to improve. But I think that's the first level. I will go ahead. I'm not going to annotate it, but I will pull up the relative chart because I think this is another way to use relative strength in your trading. And when you see the apparel retailers making a major breakout like this, and you've got a stock that just recently gapped down on very heavy volume and it continues to trade in an overall downtrend for the last 4 months, it's not rocket science. When you pull up GPS relative to its peers, it's been an awful performer. In 2018, it's been an awful performer relative to the S&P 500. So if you've got a trading portfolio and you're trying to outperform the S&P 500, you're doing it with a stock that's in a hot group, but is not hot itself. And it's also lagging the overall S&P 500. It's hard to make money and hard to beat your benchmark if you've got a stock that on a relative basis is not performing well. So I'm not a fan of it yet. I do like the reaction off of that gap down, but I think it's got a lot of work to do technically.
All right. And the most popular, it edged out a couple by only 1 vote, and that would actually be Momo.
All right, Momo. They reported earnings not that long ago because I remember, I think this is it right here on the gap up. I think it looks great. Only one problem, and I will highlight that. The problem I see with this chart is that it is overbought. So you've got an RSI that's been up in the 70s now for the past couple of weeks since we gapped up on this huge volume. I think from a price perspective, I like it if it comes back down to the top of gap support and or to that rising 20-day moving average, both of which coincide right near the 43 and a half level. So I think that's the level I would not be overly interested in chasing it. because if it does pull back, I think you could get it back down at that 20-day moving average. You'd be down more than 10% if the stock just comes down, has a routine 20-day test. And I know, you see big volume like this and a big gap up away from that 20-day moving average, but look, 5 days later, it comes back, it hits its 20-day moving average and then goes higher. I just don't like the risk of getting in at the current price. I love the stock. I would have it on a watch list waiting to see if we can get a pullback.
All right. The next one is our only consumer staples request from the Distillers Vintners, which is a consumer staple for me. Brown-Forman Corp, BF/B.
I think they reported this morning. Apparently the market didn't like what it saw, and volume is already over 1 million shares, which you can see on this chart is fairly heavy, well, very heavy volume. Unless we get some sort of kick save at the close, this is one I would not be overly interested in. I do think you've got some support right here at the prior low that we are currently below, but if it reversed and left the tail down, came back up over 53.50, then I would give it a better chance to perhaps resume the uptrend that it was in. But if we break down and we close below 53.5 today, I'm not interested.
Okay. The next one, it came to us via email, is MRTN, and that would be Martin Transport.
Yeah, this is one that's obviously been pretty volatile. We've had a couple of big days. You can see the big gap up back in January and then the failure and then a lot of sideways consolidation, the gap down in selling and now the recovery. But all of it, when you look back 5 months ago, 4 or 5 months ago, we're right where we were after this huge day where we came back down and closed at 22.5. So, just looking at it, it's something that doesn't really interest me because it seems to not have any trend. It's just all of this back and forth. If there was one thing maybe I would pay attention to, you can see that as we moved higher, the 20 is crossed up over that 50, and the 20-day test, I think, becomes very important. If we don't hold it, it's telling me we're still in a trendless market here. So I'd be careful with it.
All right. Next one, Marathon Oil, MRO, only energy sectors request.
Okay, MRO, I think, we're at a gap support level, price support level. And I think if I draw this line across here, you'll see what I'm talking about. There's your gap, big volume, came back down. We tested it, moved up close to the resistance area, and we're back down testing it again. I think we're in about a $20.40 to $22 trading range, and we are down close to the bottom end of it. So if I had to trade here, I'd be on the long side on MRO.
Okay. Next one is FireEye, FEYE.
Yeah, this is in the cybersecurity space. Continuing to hold on to support that I think is pretty key. I would actually give it down to about $16 to the downside. And I'll bring that support resistance line in here. But here was a gap up where we took out the prior highs, pulled back, and then we went through this level at 16. You can see we came back, tested 16, and then a couple of times we've gotten down below 16 and 16.50 and held. So maybe you could put a line in there. But I think these two levels are key support in this range. The recent high at 19 is your resistance, and we're sitting almost in the middle of the range. So I don't see a trade here, but my feeling is that this is still a bullish looking chart, uptrend, sideways consolidation. I think as long as 16 holds, you're okay here.
Okay. The next one I have for you is IPI. And that is, let's see, where is it? Intrepid, yes.
Okay, big volume moves, couple of them, and the pullback on much lighter volume, and I like the trend here. So I like this one. Let's pull up a trend line. And I think if you just draw a line like right in here, you'll see that we've been holding this trend line for the past couple of months. We got multiple tests now, a nice reversal off of the test of this trend line. So 440, I'd be careful if you close below 440. I think that could open up another 10% drop back down just below $4. To the upside, I would be watching the resistance level, which is just above 5, maybe about 505. So this is a trading range for me, 505 to the upside, 440 to the downside. Current price favors, it's a decent reward to risk on the long side, but actually as you get closer to 440, that reward to risk improves.
Okay. The next one I actually am giving you a little bit of a insight on what I might be talking about during drilling down, but telecom equipment, Corning, GLW.
All right. GLW, I like the volume push and breakout above the recent double top. And so let me bring in those levels that I've been watching. And the key here is that you had price support at $28, a double bottom, moved back up, and then we failed, came back down below 28. And notice as we've moved up, we've really struggled to get through 28. Well, we've now gotten through 28, and we've got a rising 20-day moving average, which has crossed over the 50. So we got a golden cross. And so I think things are improving here. Now, we are still way off the highs from a while ago. And I'm sure if we had Charlie on here to give you his relative strength, it would probably be a lot like Monster, probably be in the single digits based on where it is relative to where it's been. And then when you compare it against all other stocks. So it's starting to show strength, but clearly it's still a relative laggard over a longer period of time. But I do like the volume coming in. I just would have a tight leash. 27.5 to 28 to me is a very important area of support. If Corning were to close back below 27.5, I would be out.
All right. The next one from the banking industry, IBN.
All right, IBN.
Interesting closure of a gap.
Yeah, and I'm not even going to try to pronounce that.
Yeah, I didn't either, notice.
Yeah, I'm not going there. Let's see. Well, we got a serious downtrend in play. And on a relative basis, I know the banks have been weak, but that's a pretty steep drop from 1120 down to 820 double bottom. I think for now, it's in a trading range. I'm going to say 820 to 920, and we're sitting at 870, which is almost squarely right in the middle of this trading range. So I don't think it's a trade, not for me, because the problem is if I get in here, I guess you might be able to use 840 as a closing stop, but I'm going to be more interested in 820. So I got 50 cents downside. I got 50 cents upside to the key area of resistance, and 1-to-1 just isn't a good trading opportunity for me. So I don't like it. I like the group. I like banks, but I think that there are others that are a lot better than this one.
Okay. And our final one is an ETF, KRE.
Oh, KRE. That may have been what I was. Yeah, the regional banking ETF. This is what I was looking for earlier when I pulled up KB Homes. KB.
There you go.
So I don't know. Somebody was probably reading my mind and said, oh, I know what he's looking for. Yeah, see, now this banking ETF to me looks so much stronger. Let me pull up the bank index real quick. So when you look at the bank index, you can see we're drifting much lower. And this is made up of a lot more of the bigger banks. And then you get into the KRE, which is more regional banks, and you have a completely different picture with the rising yields. So I think that this is a really strong looking chart. And if I was going to be in banks and I didn't want to have to try to pick which bank to be in, I think this is a great ETF. I like the move to the upside in terms of this strength right here. So we got a nice trend higher. And if I go in here and put in what looks to me like maybe a cup on this uptrend or after this uptrend. So we got an uptrend and a continuation pattern, 65 to 65.5. We might see a little hesitation, maybe a pullback to the 20-day moving average, but I expect we're going to get a breakout here. I think rates are going higher. I think KRE goes with it.
All right. And that is your 10th symbol. I will have these symbols. There you go. I'll have those up in the Market Watchers live chart list for you after the show. So go ahead and take a look there. You just go to the blogs tab, click on the Market Watchers live blog, and the link to these symbols, as well as the last 2 days of 10 and 10, are located right there at the top. All right. Time to talk very briefly about ChartCon coming up August 10th and 11th. We would love to see you there. And by seeing you, I mean going there. We're streaming live. You don't have to go in person, just log on and you will be able to join in the fun. We have some great speakers and the agenda. We've now finalized all of the titles, so you now will know exactly what everybody is going to be talking about. Would love to include you. So just go to register now, and for $249, which really, considering all the speakers and the fact that you get to keep all of those recordings, is, I think, a bargain. So hopefully you will join us August 10th and 11th. If you haven't already signed up to join us live, do so as soon as possible. We've got some great plans. It's going to be a great time. Now let's move on to our final market update. All right, so these are 2-day 5-minute bar charts, I believe, 10-minute bar charts. And so we can get a really good look at what's happening right now in the markets. As you can see, Dow, S&P stayed in the positive area the entire day, now getting close to intraday highs yet once again. NASDAQ, while it started off a little rocky in negative territory, it's now recovered and is also trying to go up and challenge the intraday highs. Mid caps, very similar look, but they've been on a nice steady rising trend since just before lunch. Russell 2000, the small caps continue to show strength. You can see that we've had another up day for the Russell 2000. It never really ventured into negative territory, and currently it is reaching an intraday high. You can see that Treasury yields are up slightly, and I'm sorry, the Canadian market, the TSX, is up slightly, had more of a difficult morning, but has now made it to positive territory. Treasury yields are up quite a bit, actually. We're currently getting a reading of 2.975%. The VIX is falling once again. We're seeing a lot more complacency and comfort in the market as of today. Commodities mostly unchanged. USO oil is really pulling back in a serious way, and we can see this continuing. We now have what looks like a reverse flag possibly on USO, currently reading at 1308. UUP, big gap down and mostly consolidating sideways right now, which I think is a good thing. Gold is down at this point. Has fallen back down. It was really doing well on the open, but is now coming back down to close to yesterday's close. I want to take a quick peek in particular at the dollar and gold. I know we've been very bullish on the dollar, Tom. I continue to be bullish. But as noted, we have a PMO sell signal right now on the dollar, and we need to see that PMO unwind and decompress. So I think this pullback is great. I don't expect we're going to see a serious correction here. This is just a simple pullback, in my opinion, and we probably will see price UUP move close down to that 2450 level is what I'm expecting, and then some consolidation so we can get all of these indicators out of overbought territory. The fact that we have that nice long-term trend model buy signal suggests to me, as we've been discussing, that we shouldn't expect the dollar to have a huge correction. I thought it would be interesting to look also at gold very quickly, because typically we see a high reverse correlation between gold and the dollar. And right now we're starting to see gold decouple from the dollar and what it's doing. And, you know, I think this is good news for gold, because if we do see the dollar start to regain its strength, it's obviously going to put pressure on gold, but maybe less pressure because that correlation is starting to loosen. Currently, I do have a PMO buy signal in effect coming out of oversold territory, which is very positive. But as I've been talking about, this 1310 level is still the sticking point. We haven't been able to see GLD close above that 1310, or gold close above that 13 level. And I think it's going to continue to have problems. We could still see the PMO rising, even with some consolidation. But I'll be looking for that pop above that 1310 level if this is really going to turn into something. And like I said, even if the dollar does start to regain some strength, if we're seeing this inverse correlation lessening, we should be okay. And I will conclude this final market update. And Tom, let's go ahead and get started with drilling down. I know we both have quite a bit to share.
Yeah, and I think with drilling down, I don't know if too many of you are familiar. This is I don't know, we've been doing this segment now for a little while, but essentially what we're doing is we start with an idea, and then we drill down, and we'll show you how we kind of drill down to find some trading ideas based on an overall theme or something that we're seeing on the charts and so forth. So for me, I'm actually looking, and I've talked about this a lot with the dollar, I'm looking at small caps, and I'm going to show you how I can kind of work through what's been going on with treasury yields here in the US versus Germany and the dollar and so forth. And so let's go ahead and get into that. Okay, first I have a chart here with the 10-year treasury yield. And actually, I wanted to go back. Let's take a look at the other one. It's the same chart, except it has the Russell 2000 versus the S&P here on the bottom. But if you look at this, you can see that the 10-year treasury yield here in the US continues to move higher relative to Germany. The dollar index has a tendency to follow suit. We've gone through a few periods over the last 9 or 10 years where it didn't follow suit, where we saw the treasury yield climbing here faster in the US. It happened back in 2009. It happened again 2013, 2014. And you can see in both those cases, the dollar was going opposite, generating inverse correlation, which is very strange. In both of those cases, we saw the dollar come out of that and shoot higher. We saw it go back up and form a triple top here, but on this move, we saw a major breakout to follow the 10-year treasury yield, the US 10-year treasury yield higher. And then after consolidation, we saw again at the end of 2017 and into early 2018 that US treasury yields were again moving higher, but the dollar was not. And now we're starting to play catch up, very similar to what we've seen the last two times we've had these negative or inverse correlations. We had this back a few months ago, and look at what has happened. The dollar has surged to begin to form this positive correlation once again. The Russell 2000, when the dollar is moving higher, tends to explode to the upside, and that's exactly what we've been seeing here over the past 3 months or so. So as I go through this, I just wanted, that's the theme. So we start looking at drilling down and how we can find some trading candidates. I'm going under the premise that we are not done. The 10-year treasury yield continues to move up faster in the US than it does in Germany. I think this move on the dollar, 95 was a key resistance area short term on the US dollar. We're backing off of that a little bit, but I think we're going to go through 95, and that's going to be your first clue when we get through 95 on the US dollar index. But on a continuing move up, I think that small caps are going to be the place to invest. So what do you do with this? Well, that was the 10-year treasury yield here in the US versus Germany. Here is the dollar. You can see the huge move the dollar has made, getting back up to that 95 level before pulling back. I think it's going to continue. And if it does continue, then one way to look at this, I'm going to pull up the PSCI, which is the Invesco S&P Small Cap Industrials ETF. And you can see that we are just now making a breakout above these tops. And by the way, this is the small cap industrials. I want you to look at the XLI, which is an ETF that tracks more of the large cap industrials, and look at what's going on. Complete disconnection here between the small cap industrials that are breaking out and the large cap industrials, which are nowhere near a breakout yet. We got to get over 80, and we're sitting back at 75, 61. The small caps, the relative strength here is obvious, and I think we're going to continue to see this strength. Another way to look at this is taking the PSCI and coming down here and choosing the price indicator. And then if we take the PSCI and compare it to, say, the S&P 500, let's go ahead and pull this up. You'll see that not only are we getting a breakout on an absolute basis, clearing the prior highs around $67, but we're also breaking out on a relative basis to the S&P 500. So that's really important because money is rotating to small caps, and this particular area of small caps has been performing extremely well over the past 5 or 6 weeks, and we've seen a relative and absolute breakout. So now we're armed with, okay, small cap industrials look good. What do we do with that? Well, if we go back into the members dashboard and go into the Scooter reports and we pull up small caps, and now I type in industrials or industrial sector, now all of the stocks in the industrial sector under the small caps come up and they're ranked in Scooter order. So these are the ones at the top that look really good. Now, one way maybe to look at this is, if you look at some of these stocks with scooter ranks of 99, 98, many of these stocks probably are overbought and you'd have to chase. If we pull up Axon Enterprise, which is in the defense space, for instance, look at this move to the upside. I mean, we're nowhere near the 20-day moving average. If we get in at 68.80 and we wait for a 20-day test, or actually if we get in and then we have a 20-day test, we're going to take for me. So I love the stock and I'd keep an eye on it, but I got to have a pullback. I need something. I need at least a 20-day test before I'd be interested there. So, well, maybe there's some others. And one way to do this is to take a look at the change. And so you can see which of these industrials, these small cap industrials, where we're getting the scooter to pull back. And you can look over here and see what the scooter rank is on the pullback. So for instance, I don't know, I haven't even looked at this, but Costamare, it's traded 467,000 shares. So it seems to have pretty good liquidity. It's down 8 to 73. So it's still pretty good scooter rank, but it's down today. So maybe this is pulling back to an area to consider. Well, it moved up. It's pulled back. It's got a little support around 730, probably even better support around 7. But this was a stock near 780 not that long ago. So I kind of figure 720, 730 might not be a bad first entry. $7 could be a second entry. And if it closes below $7, you're losing the 50-day support, which we haven't lost in the last 60 days. And you're also losing price support. So this is one that you could start to develop a trading strategy for that fits the theme. It's an industrial. It's a small cap industrial. We know money's rotating to the small caps. Look at the stock. Look at the volume coming in on this push to the upside. So there's a potential opportunity. And I could go right down the list, but here's another one. Comfort, well, only 40,000 shares traded, so I'd probably pass on that. Just looking real quick to see if there's anything. I mean, some of these less than 70 on scooter ranks might be okay. Here's 171, but again, not much volume. All right, here's one, Rexnord, RXN. It's in industrial machinery, 69, so that's pretty close to 70. Scooters down 254,000 shares today. Let's pull this one up. Well, we haven't gotten a breakout yet, but it's certainly one to keep an eye on because we've got off of an uptrend, this sideways consolidation. We have been stalled at about 30.70 on 2 or 3 different occasions over the past few months. We're getting up close to that again. Look for a breakout on RXN. See if there's maybe one more, and then I'll turn it over to Erin. 75, but again, not much volume. Just want to find another one that looks pretty good. Well, let's just pull up LPX. I think we may have looked at this one yesterday or day before.
Yeah, I think we did.
10 and 10 or something, but 700,000 shares. It's down a little bit. Scooters at 63. So let's pull this one up. Sideways consolidation. We're getting close to resistance. So I'm not really seeing it. I'm going to try and find one more. All right, here's 173 scooter rank, 420,000. Again, that's marine transportation, though. We've done that. Oh. And now I'm out of the negatives. But let's check and see if there's anything else.
Well, there's 68.1 right there.
What's that?
Oh, down to Materion Corp, I think maybe.
Oh, yeah, only 17,000 shares, though.
Ah, got it.
63. All right, let's do Mastech. Last one, 197,000 shares. Let's see if this one shows us anything. Well, trying to make a breakout. I'd like to see more volume, but that is a recent high that it's trying to break out above after pulling back. Certainly, there are others on the list I'm sure look a lot better, but this is just a quick idea grabber. Maybe you can take a look. You say, okay, well, the dollar, if you're a fan of the dollar, you think the dollar is going to continue to rise. That should enable small caps to outperform. And then you just kind of drill down within the scooter ranks and in that small cap space and try and find some stocks that make sense. So what do you got for drilling down, Erin?
All right. So I decided to do things a little differently than I normally do. I decided that I wanted to start off with the sector RRG. So let's go over there. And you can get to this. It's in the free charts area. All you have to do is come down here to select what group. I selected the S&P 500 sector ETFs, and that's what came up right here. So what I did is I looked at this to see which ones were traveling in the northeast direction. For me, I like it to be on the right-hand side. We do see that as weakening, but a lot of times, and Julia's talked about it, it's all about that northeast direction. And I like the fact that technology has moved out of that weakening quadrant and into the leading quadrant. And I'll just animate this really quickly. Actually, let's pause. There we go. So we can see where technology has been, and see, even though it went into that weakening category, it shot back up into the leading by doing that northeast move. All right, so I've selected my sector. Now I need to figure out an industry group, right? So what I did is I have a chart list that just has all of the technology industry groups in it. And I went ahead and looked at them in candle glance to see which ones looked interesting to me, where I might want to go fish for some possibilities as far as a stock. And as I was going through it and I looked at, all the various setups here, I really liked this setup of the US telecom equipment. We've got that PMO that is starting to scoop upward. We have the declining trend on the OBV getting broken as it continues higher. So we've had a lot of interest in telecom. And then if you look here, I'm going to take this in a quick annotation mode for you. We can go right across here. Let's get that skinnied up and dark blue. There we go. I apologize. I don't know why this is coming out. So, oops. I don't know why this is so blurry. So I'm just going to try this. Yes, there we go. All right. So as you can see, I'm going to bring it down because you can see it in the thumbnail. We have a breakout here. We've just about managed to close this particular gap we had here. We're about halfway to it. So anyway, this one looked like there might be some possibilities here. I like that this industry is starting to improve within a sector that I like. So now what? Well, what I decided to do was go into my technical scanning workbench, and I basically kind of updated. I have a focused PMO scan that I can use and add, just a particular industry group to scan on. I did cancel out some of the rising requirements as far as the PMO. I did want it to be at least rising for one day. So I did comment out part of my regular scan. And so when we run the scan, I only end up with 2 entries, but you know what? That's okay with me. I'm going to go ahead and look at both of them, Cisco and Radware. All right, and here we go with Cisco. I can make this big again. And look at this, very similar chart pattern and PMO pattern to what we were seeing as far as telecom equipment in general. I suspect it has pulls that particular industry group around, being a large cap the way it is. But I like this. And again, now we haven't actually gotten a true breakout above this high we had earlier about mid-May, but it's on its way. I would expect to look for that gap to close. We just saw, remember, RRG told us technology is starting to improve. I looked at the candle glance. We're seeing some really great setups as far as the PMO is concerned. If you want to go ahead and draw a rising bottoms trend line on the PMO, you can see that the bottoms in price are also rising. So that's a nice bullish confirmation. And also, let me go ahead and annotate Cisco here for you. And here we go. So I'm going to take, and we're going to look at first that area of overhead resistance. There we go. So if you're using an intraday high, that's where it would be located. So I'm waiting for that breakout. But here it is. Let's see. Let's look at, I would like to show you that I am seeing an ascending triangle. It's not perfect, but I think it's pretty close. And this is a bullish pattern, and the expectation is a breakout to the upside of this overhead resistance at the top of this ascending triangle. So I think there's a lot of potential here for Cisco. I like the look of it. And finally, we'll go ahead and look at Radware. Oops, go back here, scan results, and we'll look at Radware as we get ready to close the show. And this one, we've already gotten the breakout. We got it yesterday. We're getting a pullback today, which we always like to see after a breakout above overhead resistance. The PMO is looking a little suspect, but mainly because we're getting such a down day. You know, we're 0.5% down right now, and I think that did mess with the momentum. But look at the OBV. We're seeing a lot of increase in the volume for Radware. And so I think this one also has a pretty good look to it as well. But you do have to be aware, you know, your volume, we're looking at 40,000 shares today. So it is a lower volume stock, so you may see some volatility. But I think this one looks is lining up very nicely as well. So that is the close to what I had for today for drilling down. So here's a summary of what we've looked at this point and how we decided to drill down.
A couple of different ways, you know,
exactly.
Yep.
Yeah, so I thought, yeah, going from the sector RRG would be interesting. I already was interested in technology because I've been seeing a lot of momentum gains within that sector. So yeah, it gave you an idea of how you can drill down to find some pretty interesting stock choices.
Yeah, and I think too, starting with the theme and then working your way into a position, I think gives you some confidence. And if things go against you, I mean, confidence shouldn't be construed or considered the same as like arrogance. You want to be arrogant about your pick and say, hey, I made this pick, it's going to work, therefore I'm just going to hold it. I think that can be a big mistake, but keep your stops in play. But I do think using themes, some sort of a theme to work your way, drill down to a pick can make a lot of sense.
Yeah, I mean, I run the PMO scan and it runs it on everything. But at times, I mean, this is a good way to really narrow it down so I don't have to look at 45 candle glance charts. So,
yep. Well, everybody can see the schedule upcoming. We got Bruce Fraser, Mr. Wyckoff, on tomorrow, so I'm sure that's going to be really exciting. And then, of course, Chip Anderson will join us, Everything Stock Charts. And I guess I'll be doing workshop next week.
well, I hope you are, because I'm not.
Yeah, we'll be talking about that later. But I do want to thank everybody for stopping by and being with us today. Special thank you to Charlie Kirkpatrick for joining us. Always love to hear from Charlie. Please remember to complete the survey as you exit. We do like to get your feedback. Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody. We'll see you back here on Thursday. Happy trading.
Volatility is back, interest rates are rising, and the markets are headed into uncharted waters. As uncertainty grows and the tides begin to change, you need to take action. ChartCon 2018 is here just in time, with an all-star cast of investing experts and industry-leading technicians. Watch live as these pros share their charting wisdom and guide you through their strategies for finding success in any market. Your registration includes 2 days of insightful, exclusive presentations from 15 investing legends, plus complete video recordings to watch on demand for years to come. Stream ChartCon live right from the comfort of your own home or office. No need to travel, no need to break the bank. See how the experts are protecting themselves from market volatility and reducing risk in today's uncharted waters. Join us at ChartCon 2018, streaming live August 10th and 11th.
Here's how to put a simple line on your chart without using the annotation tool. Let's say we want a line in here at 47.50. You can just drop down here into the overlays, pick horizontal line, add the price point, 47.5, and we're going to use a red line. We're going to make it solid and thick and hit update, and that blasts it into the middle of your chart.